Imagine putting every dollar you own into a single company's stock. The company looks unbeatable. The numbers are great. The CEO is on every magazine cover. Then, one morning, the stock crashes 40% overnight. Everything is gone in a matter of hours. This is not a made-up story. It has happened to thousands of real people. And the painful truth is, it was completely avoidable. The secret weapon they were missing has a name, and that name is diversification. Understanding it could be the most important financial decision anyone ever makes. Most people hear the word diversification and picture spreadsheets, complicated portfolios and Wall Street jargon. But at its core, the idea is beautifully simple. Don't put all your eggs in one basket. Spread money across different types of investments so that when one falls, the others can hold the whole thing steady. The real value of diversification isn't just about protecting money. It's about building something that lasts through every storm the market throws at it. Why concentration is a silent killer? There is a dangerous comfort in simplicity. When one stock is performing brilliantly, it feels smart to pour everything into it. Why dilute the gains by spreading money elsewhere? This kind of thinking sounds logical, but history has repeatedly proven it wrong in the most brutal ways. Think about what happened to employees of Enron Corporation in the early 2000s. Many of them had their entire retirement savings tied up in Enron stock. When the company collapsed in one of the biggest corporate frauds in history, those workers didn't just lose their jobs. They lost their life savings. People who had worked for decades were suddenly left with nothing. The concentration of their investments in a single company didn't just hurt them, it wiped them out entirely. The same principle applies far beyond energy stocks. In the dot-com bubble of 2000, investors who had piled everything into technology companies watched fortunes evaporate. Real estate investors who had all their wealth locked in property during the 2008 financial crisis faced a similar collapse. The pattern repeats itself across decades and industries. When a portfolio leans too heavily on one area, a single bad event can destroy everything. This is what financial experts call concentration risk. It is the silent killer of wealth. The antidote is spreading investments across assets that don't all move in the same direction at the same time. When one investment goes down, another may be going up. That balance is the entire point of diversification. How the smartest investors in the world use diversification. No one has demonstrated the power of diversification more consistently than Warren Buffett. Through his company Berkshire Hathaway, Buffett has built one of the most diversified investment portfolios in history.
Very rich capitalistic system, and it just so happened that what I did paid off enormously in a market system like we have. And if I'd had
His holdings span consumer goods companies like Coca-Cola, financial giants like Bank of America, insurance firms, energy businesses, and technology companies like Apple. He doesn't bet everything on one sector. He spreads his bets across industries that behave differently from one another, which allows his overall portfolio to stay resilient even when one area struggles. Ray Dalio, the founder of Bridgewater Associates,
has become the world's largest and best performing hedge fund. Bridgewater manages about 100.
Takes this idea even further. Dalio developed what he calls the all-weather portfolio, a strategy designed to perform reasonably well in any economic environment. His approach involves mixing stocks, long-term bonds, short-term bonds, gold, and commodities in specific proportions. The idea is that different economic conditions favor different assets. When stocks struggle, bonds often rise. When inflation spikes, gold tends to hold its value. By holding all of these together, the portfolio is designed to weather every season of the economic cycle. Jay-Z is another fascinating example.
To knock anyone for being successful in America, the things.
Though from a completely different world, the rapper and entrepreneur built an empire by refusing to stay in one lane. He invested in music, fashion through Armani and Rocawear, sports management, champagne with Armand de Brignac art, and even a streaming service with Tidal. His wealth didn't come from one source. It came from a deliberate strategy of building multiple revenue streams across completely different industries. When one venture faced challenges, the others continued to grow. That is diversification in its purest real-world form, but from her Fenty Beauty Cosmetics brand and Savage X Fenty lingerie line. By expanding beyond her original industry into beauty and fashion, she spread her income across multiple markets. She reduced her dependence on any single source of revenue. The result was a financial portfolio that grew far beyond what music royalties could have produced on their own. These examples all point to the same truth. The wealthiest and most financially stable individuals in the world don't concentrate. They diversify. The practical mechanics of building a diversified portfolio. Understanding why diversification matters is one thing. Knowing how to actually do it is another. The process involves spreading money across different asset classes, different industries, and different geographic regions. Each layer of diversification adds another level of protection against unexpected losses. At the most fundamental level, diversification begins with mixing stocks and bonds. These two asset classes have historically moved in opposite directions. When the stock market falls, bonds often rise in value because investors seek safer ground. Holding both in a portfolio helps smooth out the rough patches. A classic starting point for many investors is a portfolio split roughly 60% stocks and 40% bonds. This combination has historically provided steady long-term growth while limiting the damage during market downturns. Within the stock portion alone, there is room for significant diversification. Owning shares in technology, healthcare, energy, consumer goods, and financial companies means the portfolio is not dependent on any single sector booming. If oil prices drop and energy stocks fall, strong performance from healthcare or tech can offset some of those losses. Further diversification comes from mixing large, established companies with smaller, higher growth ones. Large companies tend to be more stable. Smaller companies offer greater growth potential but carry more risk. Combining both creates a more balanced exposure. Geographic diversification adds yet another layer. Investors who put all their money into one country's stock market are exposed to the country's specific political and economic risks. A recession, a political crisis, or a change in trade policy can send a single nation's markets tumbling. But if a portfolio holds stocks from multiple countries across different regions, domestic turmoil doesn't have to mean disaster. When the US market faces headwinds, European or Asian markets may be performing well, and vice versa. Real estate is another powerful tool in a diversified strategy. Real estate investment trusts, commonly known as REITs, allow investors to gain exposure to property markets without needing to buy a building outright. Property tends to behave differently from stocks and bonds, making it a useful complement to a traditional portfolio. Commodities like gold also play a role. Gold has historically served as a hedge against inflation and currency weakness. When paper assets lose value, gold often holds steady or gains. Even a small allocation to gold can reduce overall portfolio volatility during turbulent periods. The key insight in all of this is that diversification is not about owning more of everything. It is about owning assets that behave differently from one another. Two technology funds don't provide diversification. A technology fund paired with a bond fund and a real estate investment, however, creates a genuinely balanced position. One important concept to keep in mind is correlation. When two assets are highly correlated, they tend to rise and fall together. Owning many such assets provides little actual protection. True diversification requires choosing assets with low correlation to each other so that when one falls, the other is not dragged down with it. Maintaining a diversified portfolio also requires periodic rebalancing. Over time, some investments will grow faster than others, gradually shifting the original balance. A portfolio that started at 60% stocks may drift to 75% after a strong bull market. Rebalancing means selling some of the overperforming assets and buying more of the underperforming ones to restore the original balance. This also happens to enforce the oldest principle in investing: buy low and sell high. The real value of diversification is not found in a single moment of brilliant timing or a perfect stock pick. It is found in the quiet, consistent resilience of a portfolio that survives recessions, market crashes, geopolitical crises, and economic uncertainty, and keeps growing through all of it. Wealth built on diversification doesn't depend on luck, it depends on structure. And structure built wisely is what stands the test of time. The greatest investors in the world didn't build lasting wealth by concentrating their bets. They built it by spreading them carefully, patiently, and intelligently. That is a lesson worth far more than any single trade could ever teach.